The great Irish playwright Bernard Shaw once said, people always believe in their circumstances what they are. I don't believe in circumstances. The people who get on in this world are the people who get up and look for the circumstances they want, and if they can't find them, they create them. Welcome to another episode of Secrets to Real Estate and Monetary Success. In these shows, you're going to have strategies, techniques, how you can implement these into your real estate and into your business. Therefore, giving you the ability to create your own circumstances, as in the words of Bernard Shaw. I'm your host, Cliff Townsend, aka the Money Lender. And my expert guest tonight is Mark Zarilla. So Mark, I want to thank you for taking the time out of your busy day to come and share your expertise with us. How are you doing today?
Doing great, Cliff. Thanks for the opportunity to come on board. It's been a crazy week, and we're looking at some great future with the mortgage rates and some program changes. And I'm happy to share what information I have with you and all of your listeners.
Hey, I'm glad that I'm getting to spend the company of someone with expertise, which you're going to share with us in a minute. But before I do that, let me just say this, especially on a day like this, Mark. First, let me say I salute you, and I thank you for your service, because I know you're also an Army veteran, yes?
Thank you. Yes. Yeah, 10 years.
Yes, thank you for your service. Now,
Thanks.
Before we get into tonight, we're going to talk about non-traditional real estate investing strategies. But before we get into all of that, Mark, take a little time and tell us about how long have you been in this finance space, and how did you get here?
So back in 1999, I decided that I was going to make a transition from being an hourly employee, and just basically working too hard and not making any money that was equivalent to the kind of effort I was putting into my job. So I entered into the world of mortgages as a loan officer, working for a broker shop out of Florida. And we did that for quite a while. And as you know, in the early 2000s, the market crashed. So we hung on there as long as we could. Bounced back out a little bit, came back in as a loan officer again, broker. And about 4 years ago, I started the wholesale end, which is a very different form of mortgages for me. Like you, when I was in for many, many years, talking to people, helping people, and really seeing the fruits of my labor when you help a real estate agent or when you help a customer get into their new home or refinance their house. I saw a lot of satisfaction in that.
Okay.
And now I'm on the wholesale end. I'm taking all the years of experience working worked as a loan officer, and now I'm applying that on the wholesale end, where I can help people like yourself and other investors, and teach them about how I can help them with all of my different programs and how the interest rate system works to their benefit, so they can become financially successful.
All right, good. That's a good lead into what we're going to talk about, because like I said, tonight we're going to talk about non-traditional real estate investment strategies that the average person can get into without having a lot of money, credit, and all of those things. There's a lot of myths and misconceptions about how people can get into the real estate side, and especially the investing side of things. So the first thing I want to talk about is and I want you to explain to us, is the DSCR loan, right? That's a new buzzword, right? See on Facebook, Instagram, everybody's talking about the DSCR. A lot of people understand what it is. Can you give us an explanation, basic explanation? What is the DSCR?
Oh my God, Cliff, this program has taken off in the last 2 years like wildfire. The DSCR program stands for Debt Service Coverage Ratio. That's a real fancy term. And that means basically the income that your investment property has to be profitable. And that's how you can remember what DSCR stands for. Is my investment going to make me money? Because ultimately, that's what we as investors care about. We care about the property making money. We trust that property is going to make money more than we trust the borrower staying employed.
Okay, so that's a good point. So you just said that you trust the property making money more than the borrower staying employed. So that means the reason. So basically, this loan the DSCR, what is it based on? It's not based on somebody's proof of income or job. What is it based on?
Correct. So this particular loan is designed where we use the income from the property as verifying that the assets or the income is enough to offset the mortgage payment. So in a traditional mortgage, you show pay stubs or W-2s, and we qualify you based on how much money you make. Well, in the DSCR loan, Cliff, we're going to make sure that the rentals that property earns is going to be enough to pay the mortgage. We hope that it's more. But all we needed to do is equal the mortgage payment, because we know that ultimately the investor is in this property for the long haul. They're going to hold on to this property, pay it off, have a great 401k when it's paid off and it's making the money.
So that's why you say that as far as the lender will trust the property, so then they will trust the borrower because they know that the property can continuously make money.
Yeah.
And somebody has a job, and if they're dependent on their job to pay for this investment property, they can lose their job, and then there goes that. But the property can become continuously renting and make money.
Right.
So does that mean that as a regular DSCR property, can I live in it as my primary home, as my only home?
You can only live in it if it's a multifamily. So the idea behind the DSCR is it's not for your primary residence. Your DSCR program is designed solely for investment purposes. We want you to live in another property. Now, you can rent your other property. You can live rent-free. You can live with a relative and own investment property. Many lenders don't allow for that. We do. Carrington will allow you to rent your own property or live with your family members. I have a customer right now who's living with his elderly parents, taking care of them, and they need daily care. He has a job, he works remotely, but he's taking care of his parents every day, running to the doctor's appointments. He purchased his investment property while he lives with his parents, rent-free.
Okay. All right. So you said you can actually do it in a multifamily. So if I buy a duplex, a triplex, a fourplex, I can rent out. I can live in one and rent out the other three.
Yes. So that particular example is only done on an exception basis because we're looking at the rental property. So the nice thing about Carrington is we offer so many different exceptions for loans. We have guidelines, and if you have to look at these guidelines as just that, as guidelines, they give you parameters, so to speak. So if you came to us with a very positive cash flow, for example, the rent on the property is $3,000 and the mortgage payment is only $1,000. Well, that's super positive cash flow. And we might allow for an exception where you could live in one of those two units. But typically, most of the time, we want you to live someplace else. In the event that it's a multi-unit, it can be done on an exception basis.
Okay. What credit score does somebody need to be able to get into a DSCR loan?
So your credit score is pretty important when it comes to qualifying. As you know, credit scores can go up over 800 and they can go down to 0. So for this program, the minimum floor level FICO score is a 620.
Minimum FICO 620. So at 620, I can purchase use the DSCR loan for investment property with a 620 credit score. Is there a difference between the rates if I were to get to a 620? If I had a 620, see a 720 credit score?
Well, the rate would be higher, and the loan that you could get in comparison to your property would be lower. Take, for example, a property that's worth $100,000. The loan amount that you can get for that property is 75% of that purchase price. So in this example, it would be $75,000 on a $100,000 purchase. And because of the low FICO, Typically, the lower FICO means the borrower has some problems on credit. They've had some problems in the past. They may have good credit now, but it's a low FICO, so it's a higher risk for us as investors. So the rate would be a little bit higher than somebody who has a high 700 FICO. And that person who has a high 700 FICO can finance as much as 85% of the cost of that house.
So in general, what are the interest rates for a DSCR loan? Is it a lot higher than non-traditional? Than traditional loans?
You bring up a good point there, Cliff, because if you're looking at purchasing your primary residence, yes, of course the rates are going to be a little bit higher because this is an investment property, not your primary residence. However, if you're going to compare an investment property purchase, going the traditional method of using your pay stubs and W-2s versus going with the debt service coverage ratio loan, the rate will be slightly higher. In general, it's about a 0.5 point to 0.75 point higher than if you went the traditional way. Most of these customers that I found are self-employed investors where their tax returns, as many of us know, if you're self-employed, you have the benefit of writing off a lot of your income. And so they cannot go the traditional method of financing. And that's where this DSCR product is very helpful. We know they make money. We know they make good money, but we also know that the property can generate income, and we trust that the property will continue. And we rely on an appraiser who, when they appraise that house, gives us an accurate average of what this house can earn. And we use that income to qualify.
I'm glad you touched on that. Ideally, who's this loan for? Who best suits this type of loan?
Cliff, this loan is for anybody. You asked that's a very good question, except it's for anybody. I have found, however, that most people who are investing in these properties are people who invest in property as their method of establishing wealth and long-term wealth, their 401k, their investment in the future, something they can hand down to their kids, that kind of passive income that a lot of people need to get by today. It's an opportunity to purchase a house at 85% of the value. I mean, where else can you put 15% down and buy a house without showing any income documents except what that house can earn?
All right, so two questions based on what you just said. The first question is, what kind of documents is needed? Because when we talk about DSCR, we talk about no documentation.
Yes.
Something's got to be needed, right? And okay, so we know the credit. What else is needed?
So one of the more critical parts of this loan is that you do require reserves. We need to make sure that you have 3 months of your mortgage payment in some form of an account, like a checking, a savings, or a 401k, or some investment. Want to make sure that, hey, listen, if things got tough, do you have money to pull from to make those payments? So we want to see 3 months of a bank statement to show that you have money set aside, or maybe an investment account. One of the other things that we need is insurance in case your house is not rented. So we want to make sure that your insurance policy covers you for 6 months of your mortgage payments. Should something happen where there's a natural disaster, where the house can't be rented, or where you're having trouble renting it, we want to make sure that your insurance can cover you for 6 months until you get that property back up and running.
Okay, so that'd be rent loss coverage from the insurance.
Correct. Yes. And it's not a commercial policy. Many people have it. They don't even know it. It's included in their rent in the policy if they have investment homes.
How much money do I need? Kind of touch base on it, right?
I'm sorry?
And how much money do I need to put down if I'm buying?
If you're buying a property and you have a 700 FICO score or better, you need 15% to put down, plus keep 3 months reserves in your bank account.
That's 15 as in 15.
Yes.
Okay. If I have a 620, how much do I need to put down?
You need 25% down plus 3 months reserves with a 620.
So it's a range between a 15 to 20, 25. You got me correct this weekend?
Correct. And by the way, I'm sorry?
You was going to say something good.
Yeah, I have somebody right now with a 615 FICO. So we are talking concrete numbers here as examples. But if you have a borrower, a customer that doesn't necessarily fit the guidelines, or if somebody is listening and they know that their credit score isn't 620, that does not disqualify you from this loan. If you're listening and you have a 610 FICO score, credit score, give Cliff a call, because we make those exceptions, but we want to look at the whole picture. We want to look at the property to make sure the property presents itself well. We want to make sure that maybe you have a little bit more than the 3 months of reserves. Maybe you've got a 401k with 20 or 30,000. Who knows? But we'll look at the whole risk of the deal and make sure that if we apply this exception, it makes sense.
Got it. Can I use this on a condo?
Yes.
What
1
about
to 4 units. So you can do a condo, a single family, all the way up to a 4 family. We won't lend over a 4 unit because we're a residential lender.
Okay. What else would I need to know about the DSCR? Anything that I haven't asked, anything that you haven't shared? What else is there about the DSCR?
One of the things we look for, Cliff, is to make sure when you're purchasing your very first investment property, you're more of a risk. So we're dealing with 2 types of borrowers. We're dealing with a customer who is breaking into the very first investment property. That person may qualify for only 80% versus the 85%. So those are the little details that as we get into the conversation with our customers, we find out more information. Also, if they're borrowing for a 4 unit versus a single unit. So where we allow for 85% of the value of that house for a single family, if it's a multi-family, we go up to 75%. So because those multi-units are a little bit higher risk for us, we won't lend as much as 85. So a 2, 3, or 4 unit, you could get 75% of that value rather than the 85.
Okay. So we've been talking about buyers. People are looking to invest and buy something. What about people who already have a property? Maybe they have another home that they have free and clear, or they rent it out. Can they use it as a DSCR and take money out? Can they cash out in a DSCR loan?
Yes, they can. So we can do a cash out refinance on an existing investment property. Same rules apply, no income docs. We just want to make sure that they have a lease agreement. That lease agreement will show that it's equal to or greater than the loan that they're taking out. So if they're taking $100,000 cash out of an investment property, that lease agreement has to be able to show that it's making money or equivalent to the new monthly payment.
And what if they don't have a lease agreement?
I'm sorry?
What if they don't have a lease agreement, but they do have an investment property that they're going to rent, and they have it in the market, but they don't have a renter in it right this moment?
Or if it's an Airbnb that isn't being rented out.
Yeah.
Right. So we can go to 65% of the value if the house is not leased. We would consider it unleased cash out refinance at 65% of the value.
All right. So if somebody has a property, investment property that they have equity in it, whether it's rented or not, and they have a primary home, they can actually use this loan to take money out without any documentation, just because they're going to do basically a rental appraisal to see how much you rent, and if the rent covers the mortgage, they can take money out. Yes, between 65 to what's the maximum amount?
Maximum loan amount right now we're at $3 million.
What's as far as the loan LTV? What's the maximum amount? LTV 75%, 80%.
For a
somebody's taking out cash out.
Oh, cash out would be 75%.
Okay. And you said, okay, you just said the maximum loan amount that somebody is buying a property is $3 million. What is the minimum amount? If I'm buying a condo, it's $50,000, $75,000, $100,000. What's the minimum?
Minimum loan amount would be $100,000.
$100,000. Okay.
We've done them for less. Those loans are difficult because the federal guidelines now have what's called a high-priced mortgage, and we have to make sure that we don't exceed the costs to do a loan. And when you get into loans for 90,000 or 85,000, the cost to do that loan can exceed what the federal government is allowing. So generally speaking, 100,000 is our guideline. I've done them for about 95.
Okay, got it. So I said I was going to talk about non-traditional real estate investment strategies, and I want to get into the next topic, which I want to talk about because you have expertise in all of these areas. So I want to get as much of your knowledge as I can. So next thing I want to talk about is bank statement loans, right? So what is the bank statement loan? What is a bank statement loan?
So a bank statement loan is strictly for self-employed customers. A bank statement loan is an income documentation for somebody who's been self-employed for at least 2 years and shows cash coming into their bank account versus the traditional method of showing pay stubs, W-2s, and tax returns. A lot of times customers who are self-employed don't have a profit on their tax returns because, as I mentioned earlier, they write everything off. But we do know that their company earns money or their personal bank statement shows the cash that their company earns, in which case we use the bank statements, 12 months worth of the bank statements, as a form of income documentation. Now, we don't use all of that because if I'm running a business, there are expenses associated with my business. Right? If I'm running a real estate business, I have a car, I have an office, I have some expenses. They may not be much, but they're expenses. So we would take a minimum of 50% of your average deposits.
Did you say 15 or 50? Did you say 15 or 50%?
50%.
Okay.
And we can use as much as 85% of the deposits if we have an accountant verify that that would be your income.
So if I have a business and I'm making, let's say, $10,000 a month, you could, as a bank statement, I would need to show you 12 months of bank statements of money going into the business bank account. And so let's just say 1 month is 3 months, 3,000, next month is 17,000. Right? How does it work? Because my business day goes up and down. How does that work?
Sure. Where traditionally, if you had variable income, underwriters would typically average the 2 years of your variable income. So if 1 year you earned 100,000 and the next year you earned 70,000, you might see the underwriter average those years of income. In this case, this bank statement loan, which, as I mentioned earlier, is strictly for self-employed individuals, we would take half of all of your business deposits. So 1 month it's 10,000, the next month it's 20,000, the next month it's 50,000, the next month it may be back to 10. So we'll use all that income, add it up, and we'll take 50% of that as your income.
Okay, so, and after it averages out, if the average comes to $10,000 a month, so just to start, the bare minimum you take is 50% of that, so that you use $5,000 of my income, and then from that 5,000, you're gonna look at what? Look at my other expenses. How does it work?
So we don't look at your expenses on this particular loan. We just look at the bank statements themselves, and we do analyze them quite critically. We want to make sure that we're only taking those deposits that are business related. A lot of businesses have Venmo or Zelle or cash. Now, we can't use cash because we don't know where that cash came from. We don't know if it's a business expense or if somebody just gave you a boatload of money every month. So we only use those business deposits. And if there's a question, we would ask you to validate that deposit. So in your case, where you have some variable income, where some months you may have made $20,000 in 1 month, and that deposit may be larger than all the other ones. Well, we'll say, hey, Cliff, can you give us a reason why and show us a receipt of where that money came from, so we can, because it doesn't make sense why you make $5,000 every month or 10,000, and with this one month you have 100,000. Like that number sticks out to the underwriter, and we would just need to source where that money came from. But after all the deposits are made, we look at all the deposits, and then we take what's called an expense factor, and that's that 50%. And that's what we use to qualify. Or we would take as much as 80%, and that's the number we use to qualify.
Now, when you say self-employed business owners, does that include people like, Uber drivers, waiters, waitresses? Who does that include? Does that include those people too?
It includes, there are a lot of different occupations, as I found out, jobs I never knew about when I started doing loans on the wholesale level. But Uber drivers, this is a great example, or we'll go over another form of documentation called 1099 later. But a bank statement loan is for people who aren't necessarily paid a 1099. They're paid checks or Venmo'd, like a lot of contractors now take cash apps. A lot of childcare services, nurses, they take a cash app. Cash apps have become very popular, and we've learned to accept that as a documented form of income.
Okay. Can I use my personal business account?
Great question. Yes, you can use personal and business or business. We can't use both. So if you're running a business and you have a business bank account, we can't combine those bank statements. But if you run multiple businesses, we can use multiple businesses. So for example, if you're an owner of a construction company, and then you have a concrete company, and then you have a taxi service, we can use all those three businesses and add them together. If you are married and your spouse earns a W-2, we can pull the W-2 out of the bank statement and use that income separately and calculate your business deposits. So now you have a mingled form of income. You have a W-2 income from you or your spouse, plus your self-employment income.
So if I have a job, a W-2, but I have my business on the side, can I use both of those?
Yes.
Okay. What is the credit score that's needed for a bank statement alone?
Documents. So it gets a little bit more than the DSCR, right? Because now we're showing income. So we need 12 months of business bank statements or personal bank statements. We would need to make sure that after the deposits are made, you have 6 months reserves as opposed to 3 in that other loan. So you want to make sure that we have bank statements, that we have homeowners insurance. We need an accountant's letter verifying that your business has been there for at least 2 years. And the accountant's letter, if you're going to use 80%, which is the maximum of dollars we allow, if you're going to use the maximum of 80%, we would need the accountant, and it does not have to be a CPA, just somebody who's licensed to do taxes. That tax preparer has to document that you have been self-employed for 2 years with the name of the business on his letterhead or her letterhead.
Okay. What I was actually asking about is the credit score. What's the minimum credit score that you can use for a bank statement loan?
Same. A 620 score for bank statements would get you in the door.
Okay. What about?
And that's so a 620 goes all the way up to a 720.
What about loan amount? What's the minimum loan amount to the maximum loan amount for bank statement?
So the minimum loan amount again is $100,000, but we've done them around $90,000 to $95,000.
And what's the maximum? Is there a maximum?
Yeah, we just actually increased this one. I have to look at my guideline. We went up to $3.5 million would be the maximum, although we've done them over 4.
Okay, so the guideline shows up to 3.5 million. Of course, the bank statement would have to justify that.
Right.
Let's see. What else is there that can I use it for an investment property, or does it have to be for primary residence?
So most people use this for their primary residence. The loan to value that you get on a bank statement loan, in other words, the amount of money that you can borrow on a bank statement loan is lower when you're buying an investment property. We will give you more money on our DSCR than we will on a bank statement loan for investment purchases.
So on a bank statement loan, let's make sure I understand what you just said. On a DSCR, it ranges some of that from 85% to as much as 25%, or somewhere between 15 to 25% down. What is the down payment? What is the loan amount or the LTV, loan to value, that you can get on a bank statement? Is it the same 70, or can you get 80 or 90 or even 95%?
That's a great question. So let's talk about two different scenarios. If we're looking at comparing your investment purchases, if you have an investor, if there's an investor out there that's saying, I make money in my business, so I can show my bank statements, I should be able to show that and get a better value, get more money for my purchase. On investment property, the maximum you're going to get on an alternate doc using a bank statement is only 80% versus 85% on the DSCR loan. So your borrowing power is greater on a DSCR when purchasing your investment property. If, however, you're purchasing your primary residence, you can get 90% on a bank statement loan.
Okay. So for those people who want to purchase, an investor, entrepreneur, business owner want to purchase their primary residence, they can use the bank statement, and that be as far as out of pocket. If they look at buy, the bank statement will be preferential as far as the amount of money they have to come in pocket with.
That's correct.
Because they can get as much as, you said 90%, as much as 90%.
90% of the loan, and they can use as much as 80% of their deposits.
Okay. What is I think you mentioned this before, the interest rates. Interest rates are pretty much the same as traditional?
A little bit. They're a little bit higher by about an eighth to a quarter of a point. Not much more. We're going to be in the high sixes, low sevens on a high FICO mid loan. Like if you're borrowing 70 or 80%, you're going to be in the high sixes to low sevens on a bank statement loan.
Okay. Anything else? What else would we need to know about bank statement loan that maybe I haven't?
That's really it. You have to be careful. A lot of people, they say they have a lot of money in their bank account, and then after I review the bank account and I look at those numbers, I realize that they're cash deposits. And when we have cash deposits, we cannot verify where those cash deposits came from. Then we have to start talking about another kind of alternate documentation called a profit.
So you have to be a paper trail for the money coming into the business. Not getting money and put cash into the business, because you can't trace the cash.
If you can't trace the cash, we have to use a different way.
So we can't use a mattress money. We can't take the money from a mattress and go put it in the bank. We have to track it, right?
Right.
How long does the money have to be in the bank as far as
2 months
before we can use it?
So it's got to be in the bank account for 2 months.
Okay. Can I have my friend give me some money and I put it in?
I'm sorry?
Can I get a gift as far as?
Excellent question. Gift funds, and this is where it gets a little bit complicated. Let's say you're purchasing with a bank statement loan, and one of your listeners wants to finance 90%. I've got 10% down, and then we look at it and we find out that they only have 5%. You can get a gift for an unlimited amount of money. What happens with the gift money is we only really need you to have 5% of your own funds. The rest can be gifted. So if you qualify for 10% down, you could get a gift for 5% and you can put in the other 5. If you want to do an 85% loan, you just need your 5%. You could get a gift for the other 10.
Okay, so you can get a gift.
Yes, sir.
Okay. What about can I get a gift? Would it be the same thing on the DSCR or on the bank statement?
Yes, same rule applies. It's DSCR or the bank statement.
All right. So those are a lot of options. A lot of options people have as far as those loans are concerned. You mentioned it earlier. So the next loan I'm going to talk about is a 1099. Now, a lot of people are familiar with 1099. Can you tell us what kind of loan this is? I mean, it's kind of self-explanatory, but just explain what kind of loan is this?
Yeah, it's pretty straightforward. It's you use the calculation the same way as a bank statement. So if one of your listeners has 1099s, meaning they work for different companies, and those different companies at the end of the year give them a payroll certificate called a 1099, and you've earned $20,000 with company A, $30,000 with company B, $8,000 company C. You get all these 1099s together. We add them up, and we apply that expense factor of 50% again. And that would be their income that we use to qualify for the loan. So after all the 1099s are added up, we have somebody who's made $200,000. And that's traceable. We know where that money came from. So there's no argument. There's no underwriter that's going to say this money cannot be used because I can't trace it. The name of the company is on the 1099, right? So it's sourced. And we need 12 months worth of those 1099, so 1 full year. And we apply the expense factor of 50%, and that money that's used. Now, unlike the bank statement where they can go through all those deposits, and the underwriter can pull out some deposits that may not be business related. You may know that they're business related because they're cash, and somebody happened to pay you cash. In this case, the 1099 takes the guesswork out of it. We use all that money. We use the expense factor, and that's what they qualify for.
Is the expense factor still the same, 50% all the way up to 85?
80% is the maximum, 50% is the minimum.
And is there like anything different? Is it the same credit criteria, 620 FICO and up?
Yes, so the 620 gets them in. The difference here is your accountant would have to also verify what the type of business they do. So they have to write a small description. Cliff Townsend is a mortgage specialist, and he makes his money by helping people get mortgages for their homes. Mark Zarella is a taxi driver, and he earns his money by driving a taxi, right? Very basic description of how they make their money. And if I need 80% of my deposits to qualify for the mortgage, the accountant has to state Mark Zarella operates a business at a 20% expense level, meaning 80% of the deposits is my money.
Okay, and 20% goes towards expenses or whatever it is. So this sounds like it's an ideal loan for strategy or contractors, subcontractors, consultants.
Yes, traveling nurses, Uber drivers, contractors. Sometimes they get paid a 1099. I do see some contractors, but most contractors go with a bank statement type loan. But any kind of gig worker would be a 1099. Bouncers, maybe bartenders get paid 1099s. Those are the types of jobs that get a 1099. And there are many, many more. I just haven't seen them all yet.
Yeah. Okay. What's the loan amount? What does the loan amount go up to for 1099?
Guess what?
3.5 million.
Yes. You're listening.
Now, the last one I'm going to talk about tonight is, I think it's similar. P&L. Can you tell us what that is? What kind of loan is that?
That's their profit and loss, near and dear to my heart.
So how does it work? How does the profit and loss work?
So this loan is used when you have somebody who gets paid cash and they make a boatload of money. There's a lot of money coming into their business or their personal bank accounts, but it is all cash, or there are many large deposits. Anytime a bank statement is in question, and I'm going to tell you the reasons why bank statements are not used. If the person has a lot of non-sufficient funds, believe it or not, Cliff, there are a lot of people who don't manage their money properly. I had a borrower who paid over $1,300 in non-sufficient funds transactions. They had no idea that they were overdrawing on their account. They made $75,000 a month, and they would overdraw. I also had loans where bank statements were showing very large deposits, and then they would go dormant. There wouldn't be any deposits for several months after that, and then they would see larger deposits. Now, that person traveled, took a lot of vacation time, and it was also in a business where it was variable income. So whenever you have that type of income where the underwriters can really critique those bank statements and possibly disqualify you, cash deposits can't be used. Non-sufficient funds, any more than 5, have to be explained. And if it's financial mismanagement, we may not trust that the loan is a solid loan. Those are the times I flip the loan to a profit and loss, because now bank statements are not critically looked at as income. Instead, we're using an accountant's opinion and the fact that they've done the tax returns to state what their gross earnings are, less the expenses to run that business, and then we see the net earnings. And we use that net earnings as the qualifying income. So the underwriters don't see the non-sufficient funds that could potentially disqualify our customer because they didn't pay attention to those overdrafts. Or we can use all those cash deposits now because we couldn't use them with the bank statement loan because it's untraceable income.
Yeah.
But now the accountant understands the nature of this person's business and that they're paid cash, and now we can use all that money. And it has saved more loans than not.
So this is a more flexible loan. And I guess who ideally would be a right fit, perfect fit for this kind of loan, profit and loss?
Profit and loss loans are good for a lot of my real estate agents who collect a lot of rent from different sources. They also get paid from their broker. They may run another business. So when you're getting multiple deposits from aggressive entrepreneurs like real estate agents, like investors, and it's hard to really show where all that money is coming from, and they may vary in large deposits, those are the people where the profit and loss simplifies it. Contractors who get paid cash, combine the cash with Zelle or any cash app, combine that with a 1099 from another company. You can't control how you're paid by your customers. If your customer wants to 1099 you don't want to turn the money away, so you do the work. So now you've got 1099, cash, checks, all these different cash apps coming into one bank account. The underwriter will have a nightmare trying to decipher where this money's coming from. So it's a lot easier, it's seamless, it's faster, and it's painless. You go to your accountant, you get the gross income minus the deductions, net income, and that's what we use.
All right, that was a great explanation. Thank you for sharing that.
You're welcome.
Sharing all of this knowledge between DSCR loan, bank statement loan, 1099 loans, and profit and loss. Out of all the things that we've discussed tonight, right, all the different kind of non-traditional real estate investment strategies that every person can use and put into their real estate and into their business. What overall, how do you summarize this? We'll share something that, as far as any of these loans, anything that we didn't ask, anything that you want people to know about any of these loans, whether it's a bank statement, a DSCR, 1099 profit and loss.
A couple of things I want to highlight. The interest rate is the same for the same borrower. If you have a borrower that thinks they're going to get a better rate showing bank statements rather than going through the profit and loss, not true. It's the same loan. It's just documented differently. So the profit and loss is the easiest way to go. It's the same rate as if you gave me 24 months bank statements. It's the same rate. So take the guesswork out of the loan and get the same rate, and you have less headaches getting the loan done.
I was going to ask that question. I was going to ask you, which one of these loans would you say is the easiest to get done?
I read your mind.
You said it profit and loss. Now, how long does this process usually take? Whether I do a DSCR, a bank statement, the 1099, a profit and loss, let's just say I'm buying or I'm cashing out. What, 2 weeks, 3 weeks, 4 weeks, 5 weeks? How long does the process normally take?
We work as fast as the loan officer and the customer. A lot of customers don't understand the urgency involved in getting a loan closed. It is imperative that customers get the required documentation. Invariably, there's something that pops up on these loans. Maybe the appraisal is low, or maybe the rental came in a little bit lower, and we may have to rework it. But anywhere from 3 to 5 weeks is what I've been closing my loans with. And these are good. Part of understanding how the market works now is we have to make sure that we're taking in good loans and that the property is valuable and it presents itself well. So we go through a lot of steps to ensure that the income and the information is accurate, and that takes time. So yeah, 3 to 5 weeks, we can close a loan. All
right. Hey, thank you for sharing that, Mark. I want to thank you for sharing your knowledge and your expertise with us tonight. And once again, before we go, I do want to salute you and tell you thank you for your service as an Army, 10 years in the Army. So, and once again, thank you for sharing the knowledge with us. And I definitely want to have you back. I definitely want to have you back and focus. In fact, there's another, I know you have a lot of expertise with a lot of other investment strategies. So I'd love to have you back and share some other knowledge about how other people can use different strategies to get into real estate. And so, but we'll talk about that another time. But thank you for your time.
Absolutely.
And I appreciate the information you gave.
Thank you.